Hello everyone, I'm Shain Vernier, market analyst over at Forex Signals and HowToTrade.com. We hope that you've enjoyed our Basics of Trading mini-series. Today we will cover our 8th concept, one that many traders overlook, intermarket analysis. The contemporary marketplace is an interconnected atmosphere of traders, brokers, market makers, and the general public. Gone forever are the days of isolated products and asset classes. We truly live in the era of globalization and connectivity. Accordingly, it has become increasingly important for traders to understand the relationship between markets, products, and financial instruments. Now, as active traders, we must develop an understanding of how markets complement one another. By doing so, we can get a firm grasp on why, how, and when prices are apt to move. The ultimate goal of any form of analysis is to craft strong trading decisions. Intermarket analysis can help us achieve these objectives. Now, intermarket analysis isn't difficult. In fact, it's rather intuitive. Have you ever traded a commodity dollar like the loonie or Aussie? How about stocks or bonds? The US dollar and commodities? Odds are you are more familiar with intermarket analysis than you think. So what exactly is intermarket analysis? Well, basically, it's a way of evaluating the markets by studying the correlations between unique asset classes. All right, let's take a closer look at this discipline and its foundational tenets.
Okay, so what exactly is a market correlation? A market correlation is the relationship of one asset's price to another. That means asset A and asset B have some sort of relationship between their price action. Now, it's a quantitative measure. That means it is expressed in terms of numbers, statistics, on a scale between -1 and +1. Now, it's important to understand that there's correlations and there's perfect correlations. Now, perfect correlations are very important. They set the boundaries for our -1 and +1 scale. So right here, a perfect correlation is present when the price action of one market may be forecasted precisely by the price action of another market. That means that if we know what market A is doing, we also know what market B is doing. Very, very important. Perfect correlations carry a value of -1 and +1. Now, a perfect correlation, of course, we just covered that, came in two different types. The positive one, the positive perfect correlation is present when the prices of independent markets move in tandem. That means if market A is going up, market B is also going up. Now, a perfect negative correlation occurs when the prices of independent markets move in opposite directions. That means if market A is going up, market B is going down. Market A is going down, market B is going up. So that's this is the key to correlations. It sets the boundaries for our scale. A positive correlation and a negative correlation. Very important to understand. We have correlations and perfect correlations. Now, correlation tips. The biggest things that if you're going to trade correlations, correlated markets, interrelated markets, you're going to need to understand these three things. Now, number one, a perfect positive and negative correlations are rare, extremely rare in the live market. If you see one, definitely take note. Most correlations, most related markets fall somewhere on the spectrum between +1 and -1. Always remember that correlations are always evolving. Just because something's correlated today does not mean it's going to be correlated tomorrow. We may have a fantastic correlation today, a perfect correlation today, but perhaps later next week or the week after, that correlation has faded to half of what it once was. So always remember that correlations are always evolving. If you're going to trade these in the live market, you need to stay as current as possible. Now, this is a good look at a Forex correlation table. Many of you have probably seen this if you traded Forex at all. Right here is our base asset, our Euro USD, and right across the top here, we've got the dollar yen, we've got the Swissy, we've got the cable, we've got the loonie, we've got the Aussie, the Kiwi, and so on. You can see right here we have different durations of time: 1 week, 1 month, 3 months, 6 months, 1 year. And you'll notice here are our correlation values. We have a perfect negative correlation right there on the 1 week scale with the Swissy. So that's definitely something to make a note of. A perfect negative correlation. That means if the Euro USD is going up, the Swissy is going down. Very simple to use. So a table like this can be very useful in your active trading. Just understand that just because something has a high correlation, either positive or negative today, it doesn't necessarily mean that it's concrete. Correlations ebb and flow over time. That's a major point to remember. Okay, that's enough theory, that's enough definitions and all that jazz. Let's go to the live charts. Let's see if we can take a look at a few real-world examples. Okay, let's go to the real-world situations. It's one thing to look at concepts and read theories and all that, but we have to be able to apply these things in the live market before we can really do any good with a tool like correlations or intermarket analysis. So let's go right to it. We're going to show you one positive correlation, one negative correlation in a market that really, a correlation that really is evolving. So the first pair we're going to look at here is the Australian dollar, US dollar, as it with respect to gold. Now, this is a traditional positive correlation. The Aussie has a strong correlation to gold, iron ore, and copper. Those are really solid metals, and a lot of that has to do with the production of the metal out of Australia. In any case, right here, we look at the pricing chart, and the positive correlation is self-evident. If you just take a look at what we have here, you have a nice big run up in gold, and then you've also got a nice, I call it mirroring. I mean, the Aussie basically is mirroring the price action of gold. That really is a huge signal of a strong positive correlation. Now, the second thing that we're going to look at here is a negative correlation. This is sort of a traditional Forex negative correlation. You've got the dollar CAD against the cable, and it's a negative correlation. It's negative 0.73 historically. So if we look really at this chart, it's self-evident. That's the biggest thing that I want to point out when we go to the charts and look at these concepts and say, okay, it's fairly obvious. Now, I find from my experience using a line chart is probably the best way to see these correlations visually, to get a nice visual depiction of these correlations. But you can see right here from price, I mean, you've got a nice rally right here in your dollar CAD, and at the same time, you've sort of got a sell-off in the Great Britain pound USD. Now, a lot of that has to do with the USD being the base and the counter currency for these pairs, but it's still important because it shows that the Canadian economy and the UK economy definitely have a pull on they play a major role in the valuation of these pairs. So when we start looking for correlations and we see a negative correlation, something like a negative 0.73, you'd be looking for a rally in the CAD and possibly be selling your cable. Why is that important? It's important so you don't get double exposure. You want to understand that if you're holding a long in the dollar CAD and you're also holding a long in the pound dollar, you could be headed for trouble. You really could be headed for trouble if you're doing so for any length of time. So you definitely want to be aware of that. Very, very valuable information for diversification, but also for risk management. You don't want to get involved in trades where you win one but you lose the other consistently. You always want to be aware of these correlations. Now, lastly, we're going to look at one that's evolving, the dollar index and U.S. oil. Now, typically the relationship between the dollar is the higher the dollar goes, really the weaker the commodity prices get, and that's exceptionally true, especially true for U.S. oil, or it has been traditionally. But you can see right here that we really are changing. I mean, the market really is changing a little bit. It's not necessarily a factor where the dollar goes up and crude oil goes down, or vice versa. It's one of those deals where there are so many market drivers impacting U.S. oil that the dollar, even though crude oil is denominated in dollars around the world, it's not necessarily the end-all be-all to price. So I would say that this is an evolving correlation, one that has been strong over the years. It's sort of been a negative correlation, strong dollar, weak oil, not necessarily the case anymore. So there's a good example of a positive with our Aussie gold is a nice positive correlation. Markets move in tandem. You've got a negative correlation right there with the dollar CAD and the cable. Markets move in opposite directions. And then you've also got an evolving correlation where there really isn't a whole lot of rhyme or reason to much of what's happening here between the dollar index and U.S. oil.
Intermarket analysis is a great way of placing market moves into context. And correlations can certainly help us understand the relationships between asset classes. However, these tools aren't trading's holy grail. They're only one perspective on the markets. To be a well-rounded trader, it's vital that you also grasp other viewpoints, such as fundamental analysis, technical analysis, and price action strategies. We hope you've enjoyed our series on the foundational elements of trade. We would love to hear from you, so feel free to leave a message below. If you want to learn more about the markets, check us out on the socials, hit the subscribe button, or pop into the trading room. Until next time, trade the action well, and we'll talk soon.